If you're involved in production agriculture, especially with crops like corn, wheat, and soybeans, you'll have noticed that commodity prices are currently far from their record highs. In fact, we're seeing fresh 3-year lows for some commodities. When markets are down, it feels like they'll never rise again, which tempts people to sell options. But is this the right move? I can offer you 10 reasons why I might not want to do that. From my childhood, I was taught, buy the dip and sell the rip. Option volatility in grain complex is at extremely low levels, yet every market experiences its own volatility. I know just the person to discuss this with. Please welcome Scott Bauer, CEO of Prosper Trading Academy. Scott, what do we do with low volatility during these times?
You buy it, and then you buy some more. And here's the reason why. Just because volatility is low, okay, doesn't mean a particular stock, or in this case, if we're looking at a commodity and ag, doesn't mean you may be bullish or bearish. You can have either opinion. But if you're trading options, one of the most important things, which a lot of people don't understand, is how expensive are these options? And volatility is what drives the expensiveness of these options. So if you look at corn, for instance, right now, corn, as you were just talking about, that's one of the commodities that has just been, taking it on the chin. But option premium, option volatility in corn is at a multi-year low. That means if you want to get into that marketplace using options, you can get into it on sale. But again, so many people confuse buying or selling options with direction, with being bullish or bearish. So you guys can see on the chart right there, and I follow this daily. I took this right from the CME. This is something that they track daily called CVol, okay, and it tracks volatility. So if you look here, you can see the price of corn, really, really bad, but the volatility is down at the bottom of the barrel. One of the things in trading, okay, one of the nuances, especially with volatility, is volatility will always revert back to its mean. So when it's really, really cheap, it's going to come up and get more expensive, which will make option prices more expensive. And when it gets really, really expensive, it's going to get cheaper, which will make option prices cheaper as well.
That's interesting. When you think of options, we explain as insurance. Now, I work at Advanced Trading. I'm a commodity broker. We are still buying puts for the downside, even though everyone wants corn to rally. But with the way we're thinking about it, in the 24 crop, options are affordable. And we don't have crop insurance yet. It's the month of February in the grain market.
You do now.
Well, we do now, right? And so if the United States government isn't going to cover your butt, we look at it that we got to help cover these costs. And although $4.70 corn in DS24 feels inexpensive compared to what it's been before, believe it or not, the risk, as you know, is still we go lower. So why not make the investment on that insurance and hope we go up? It's something we teach and try to educate people on every day. And then if the market does explode, do you know what they say to us, Scott? When they get their 1099, you cost me 20, 30 cents.
Exactly. But here's the deal, right? When volatility is cheap, just like if I get this question all the time. If someone's trading stocks or you have your portfolio and you want to stay long in the market, you want to ride the wave up, right? But you also need to have that insurance. Buy it when you can and not when you have to. And now is a time where volatility is typically very, very inexpensive across the board. So yes, you go out and anybody can go out and buy their auto insurance and their homeowners and their personal articles. And you know what? You hope you never really have to cash in on it, right? It's there for insurance, but you shop for it. You want to get it as cheaply as possible. Well, it's the same thing when you're trading options. And that insurance can be for a downside move. It can be for an upside move. But when volatility is cheap like this, that's when you have to step in. And when it's really expensive, that's when you're a seller because those options will get cheaper.
Yeah, but if you get too many people selling calls at too low of a price, I mean, if we went out right now to every farmer and rancher and told them sell volatility, what would happen? Explain to the American farmer. If we're at 470 corn and we go to 670, as you know, there's probably not even much snow in Colorado. America's really warm right now. I mean, in Minneapolis, they had to pull the ice houses off the lakes, right? So if we went into a drought or something weird, what would happen if you thought grains can't go up, you sell vol, and we have an explosive rally? Explain how uncomfortable that is.
Oh, it would be brutal because the volatility, the premium and the options are going to start exploding because now all of a sudden there's going to be buyer. And really what happens is it's just a market of supply and demand. It is basic economics, right? When there's a lot of supply for anything, prices are lower. When all of a sudden people want that protection or people want, they need to own something, whether it's for a big explosive move to the downside or upside, the demand is there, so prices go higher. That is how the marketplace works. It's efficient. It's the old adage of supply and demand. That's how it works.
Awesome. I got a couple other questions. We have a little time. Last week, Facebook, aka Meta, had earnings, right? I looked at puts and calls. It had about $20 that they thought it could move, right? Throwing your curveball. It moved $80. The person short that call. Oh. Right?
That's why when I sell options, I will only do so on a spread, meaning I may sell something real expensive, but I'm going to buy something else cheaper against it. So if I do get that outsized move, okay, at least I'm stopped out and I know what my risk is. I never will have that open-ended risk. So yes, you saw that in Meta. You see that today, and I know it's not ags, a stock called ARM, ARM, made a 50% move on earnings today. So, you have that. They're selling options. People like to collect credits. It can be dangerous.
Scott, I knew you were just the guy to have on the show and talk about this. Enjoy Beaver Creek, Colorado.
Thank you very much. Have a great one.
See you, buddy. Scott Bauer joining us from Beaver Creek, Colorado. And we're going back to the classroom. What's going on in the classroom? If you look at one district, it certainly isn't learning. They can't even do basic math and reading. Is this the results of those COVID lockdowns? I bet Dr. Carol Swain can shed some light when Cow Guy Close returns.